Hello and good day to you. It's a lovely hot day here in Las Vegas, and I'm back with episode 2, where we will discuss episode 2, I should say, of how to avoid the most common and costly mortgage mistakes. And the topic of this episode is going to be the 3 biggest determinants of your mortgage, along with some related topics. We're going to try to get through this quickly. I may not be able to get through it in the promised 3 to 5 minutes like I promised in my first episode, so I may make this a 2-parter. And then of course there's still many other episodes to come to try to help you guys save some money on your mortgages, and not only just save money on your mortgages, but make sure that you structure your loan in the right way so that you can create wealth and be prepared for retirement when that time comes as well. We want to look at the big picture. We want to look at the 20,000-foot view and not just focus on the small minutia, the minute details of your transaction right now, because you know that amounts sometimes to stumbling over dollars to pick up pennies. So we're going to start off with the 3 biggest determinants that you're going to pay in your mortgage. And so the 3 things that determine the amount that you're going to pay over the life of your loan are: first, your loan amount; secondly, your interest rate; and third, the term of your mortgage. So, you know, in this example, we're going to use a $200,000 loan amount. We're going to use a 6% interest rate, which is below the historical average but above where rates are today. I just felt like for, posterity, and over people watching this 5 years down the road, they might relate better to a 6% than a 4.5% mortgage, and so on. So I thought that would be just a better representation of where rates will probably be on average. And we're also going to look at a 30-year term. We're going to talk about how that compares to a 15-year term. So the principal and interest payment, and that's really all we care about when we're talking about the mortgage, because taxes and insurance are going to be the same regardless. So a payment, principal and interest, on a 30-year mortgage at 6%, that's a $200,000 initial loan amount, is going to be $1,199.10. Now, compare that to a 15-year fixed $200,000 mortgage. We'll say at 5.5%. Difference between a 15 and a 30-year can vary anywhere between 0.25% to 1%, just depending on the yield curves and some other things. But for now, let's just use a difference of 0.5%. So at 5.5% on a 15-year $200,000 loan, your payment's going to be $1,634.17. So that's a payment difference of $435 more on the 15-year versus the 30-year. So obviously you're going to save a lot of money in terms of the interest that you don't pay on a 15-year versus that 30-year. For instance, you're going to save $137,525 by going with that 15-year in this example versus the 30-year. But you're going to also pay $435 more during that 15-year period. So even though your total savings is very significant, there's also something called an opportunity cost when you choose the 15-year mortgage. And that opportunity cost is the ability for you to create wealth if you chose the 30-year mortgage. So for instance, choosing that 30-year mortgage, if you commit to a $1,634 payment, you could put $1,199.10 to your mortgage like you're obligated to, and then use that other $435 a month for investing. Now, if you do that and you get an 8% return on your investment, which is a relatively conservative return number, you're going to end up creating about $150,526 in wealth, which is more than the $137,000 in savings. Additionally, not only are you creating that wealth, and we'll talk about time value of money and the rule of 72 and doubling and that kind of thing, which is hugely important for getting your head start and really preparing you for retirement. We'll talk about that in a later episode. But not only are you creating that wealth, but you're also being liquid. So there's lots of reasons to have liquidity, but if you were to lose your job or something happened and a big financial emergency came up, if you had all of your money tied up in your house, if you lose your job, you're not going to be able to qualify for a loan to get money out to be able to pay your property taxes and your mortgage if it's not yet paid off and things like that. So you put yourself into an unnecessary hardship situation by tying that money up into into the illiquid asset that is your home. Another thing that happens is that your home is going to appreciate based on what the market is doing, not based on how much money you have invested into your home. So it's very important to remember that if you really want to create wealth, real estate's a great way to do it because you can do it with leverage, which means you can buy a $200,000 asset, or let's say a $250,000 asset, put $50,000 down, and now you have the $200,000 loan that we're talking about. But then also using other monies to invest in other things so that you have that growing for you as well, because putting any more money into the home isn't going to make it appreciate any faster or create any more wealth for you. So I think we're going to stop there for this episode. I think we've covered a lot, and I hope that you've got a good understanding of that. We'll also talk about buying rates down versus putting more down payment down. In fact, let's talk about that really quick before we end this episode. So if you take 1% of the loan amount and you buy down the rate, which typically 1 point is going to buy down the rate about 1/4%, you're going to save $34 a month, just over $34, $34.24 actually in this scenario. Now, if you were to say, but I'm going to use that $2,000 to lower my loan amount, and so instead of a $200,000 loan, now you've got a $198,000 loan. That will save you $12 a month. So you really get a much bigger bang for the buck by buying the rate down than by lowering the loan amount with that same amount of money. The other thing that happens is, depending on your specific tax situation, you might have some more tax benefits. So if you're in a 25% tax bracket and you get to itemize your deductions, that $2,000 will really only cost you $1,500. So that puts you in an even better scenario. And I would also add that on the investment side of things, since your 30-year mortgage will provide you with the tax deduction for a longer period of time than your 15-year mortgage will, that $435 that we talked about for investing is actually going to be more than that because of the tax deductions that you'll have. So just leaving you with a couple of those thoughts. I hope that this was all good information for you and that it gets you thinking about the proper way to structure your mortgage and the things that you can do with your money to help you create wealth outside of your home so that you can really prepare for retirement. I've got some great things coming up with regard to preparing for retirement, and hope that you'll join us in the upcoming episodes so that we can really help make sure that when it's time for you to do a mortgage, that you are well prepared and will make all the right choices so that you can save the most money on the mortgage side but create the most money on the wealth and investing side. As always, if I can help you with a mortgage, I would be honored and I would love to do it. Please contact me, Jed Wonderly, with Noble Home Loans at 702-812-1214. That's 702-812-1214. I look forward to talking to you. And again, I hope you enjoy the series. Please like, comment, and share. And let me know if you have any questions or if there's anything I can do to help you, or if you have some ideas for some other episodes. Look forward to helping you out in the future. Take care and have a great day.